When you look at the stock market in China, you are presented with two tales, one of which is proposed by the government and the other is reality. You take your pick. There is no denying where the market has come from and also where it has been. Today we see the incredible weakness and it won't let up anytime soon. You came here for the truth, so let me unveil that for you. More unpopular information to discuss with you today. I got charts, I've got articles, I've got some very important information that I think is not being discussed by the mainstream and even by the alternative news, because this information is quite important and a lot of people don't like to touch on the things that are truly important. About $1 trillion worth of stocks listed in Shanghai or Shenzhen, China's two main markets, are being pledged as collateral for loans. Big problem right away. When I see that, I start to get worried. This article is out of the Wall Street Journal, and what we are talking about here is such an important factor to the reason why stocks have risen. Yes, we have QE. Yes, we have buybacks. But at the same time, the retail, the average person has been magnifying their gains as well as the risk by taking on margin, by using their stocks as collateral even. These are big problems that are always going to be a disaster when stocks drop. You've already had the stock market coming down by a significant amount, and here we are adding gasoline to the fire. All right. The equivalent of 12% of the market. Now somebody would say, well, that's only 12%, but that is a significant amount. You only need a spark. That's it. Plenty of Chinese stocks are also used as collateral in margin financing, whereby investors borrow to plow more money into stocks. A lot of people think they're geniuses by doing this, and they will be burned eventually. In all, some 23% of all market positions were leveraged in some way by the end of last year in China. 23%. Nearly a quarter of all of them are leveraged. What a mistake. Now, on the way up, you look like a genius. You look like you made the right decision. And then when the market comes down, it burns you bad. The pledging of shares as loan collateral is particularly prevalent among the smaller private companies. Unlike in the US, where institutional shareholders are a big market presence, private Chinese firms are often controlled by major shareholders who often own more than half the company. Okay, so let's go into more details. All I care about is the fact that statistically, when I see this amount, okay, a lot of money and a lot in terms of percentage of the total market is being leveraged, it is truly worrisome. Not when the market is going up, but when it's going down, of course. Let's take a look at the Shanghai Composite, and you can see that it has come down 22% from its high in the end of January. It is still down, although the market did come up in the last trading session here. We will see that overall it has been going up and down, but the trend is definitely downward. Why the stocks in the US and China have gone up, even though we have more trade issues than ever before, well, you can ask them, because I clearly don't have a response. Collateral damage, leverage positions in China's A-share markets as a percentage of the total market cap. You'll see that increasing here, and it does show me that we have a big problem and they are adding gasoline, like I said, to the fire. We're going down to before 2015 here, I'm assuming around 2014, that's around 9%. And today, you're looking at about 23%. Huge mistake people are making by doing this. Further in that article out of the Wall Street Journal, the risk for other investors when big shareholders take out such share-backed loans is that stocks can plunge sharply when the borrowers run into trouble. They mentioned an example here, falling 85% in one day. It's unclear what triggered it and so on. Okay, then it talks about some others down at the bottom here in this paragraph saying that in these cases, half or even more of their shares pledged as collateral for loans. That is not a good sign. When you think about that, if individual companies are affected by this, as soon as it starts to go down a little bit, and we're already down 22%, I don't understand how they're going to be able to withstand it other than collapsing, and then the central bank will have to come in at some point. Maybe they'll let it drop down to 30%. Maybe 25. I don't know what their number is, but we're going to be watching it very closely, I assure you. The recent sharp Chinese currency depreciation should be setting off alarm bells for the global economy, but of course it's not. That's just the way it is. So this article is talking about this currency depreciation in the third paragraph here. Look at what they say. It's depreciated by some 6%, taking it to the sensitive level of 6.7 renminbi to the dollar. I've talked about the 6.7 level before. I don't know that that necessarily means anything, but you could see that they're trying to hold support around that level for now. They did that previously a little while back. And again, today we see what has really occurred, and that is the weakness of the system that they've created completely based on quantitative easing. Why not make it strong? Well, of course, they can't do that with the printing press. So this is all we get. We get fragility, we get risk, we get people taking even more risk on top of that, and it always ends badly for a lot of people. And that's just, quite frankly, the way it is. It's going to go more into this, but I'd like to move on because I do want to get into another issue. If you remember, I covered this previously, and it brings me to my point. FANG insiders are on pace to sell $5.2 billion of shares in the first half of 2018. Okay, so we can estimate that it was around that. I want to see some new figures based on that, and I will bring it to you. But look here for yourself. $5 billion worth of shares being sold by the insiders. They wait for the opportunity. Remember, I brought this to you and I was called a fearmonger. I was called an idiot, even though this is literally a fact that they admit, and it's not in secret, it's nothing like that. That the insiders, they purposely do, they push up the stocks in their buybacks, push it up. Once it's up, they sell their positions, and they do it over and over again. That's how they're selling off their positions. They push it up with buybacks, sell off. Push up with buybacks, sell off. They know exactly when it's going to happen, and they've been doing so. I don't know how much they're going to take, but maybe they just want to take just enough, buy what they think they'll need over the next little while. Maybe they need a house, maybe they need cars, and so on, and they're selling off enough for that. And then, if it's a person like Warren Buffett or somebody, one of the Mark Zuckerbergs or anything, maybe they know what's going to happen in the future. Maybe they don't. I don't really know, but they're probably know more than me, that's for sure, about what's going to happen. All the insiders meeting at these things like Bilderberg and Davos. Insiders at tech heavyweights led by Facebook's Mark Zuckerberg are selling stock at the fastest pace in 6 years, cashing in on a buoyant equity market. Now, this is what I've talked about, of course. I say that, and it's fear-mongering, but it's on Bloomberg. That's literally a fact. Senior execs and directors of Facebook, Amazon, Netflix, and Google's parent Alphabet have disposed $5 billion of stock this year, and they're on track to exceed $5 billion for the first 6 months of 2018. So again, we're looking at this information. It's a little outdated, even though the article is actually new, but the information is coming from the newest available data, I assume. And if you remember something, I'm going to show you. This has been the highest since Facebook went public in 2012. Now, in 2012, if you remember specifically, when they had their pump and dump, it says right here, they pushed the first half insider sales to $14 billion. They pumped it and they dumped it. And that's really successful for them. Now, yes, the stocks have come up since, but that initial sort of flow that came out, they cashed out. They knew what they were doing. Okay. Let's go into this a little further, but essentially talks about how Zuckerberg alone he actually sold off $2.84 billion of stock this year. He talks about being philanthropic, and I think that is quite funny. All right. Now, there's more details in that, but let's show you this here. Buybacks and dividends paid versus the S&P's value. I want to show you the fact that throughout 2018, you can see the numbers here. Now, I don't know if this has been updated recently because I'm seeing no dividends, so I don't know exactly where the calculation is coming from. I'm sure these companies have been giving dividends, so that statistic, I would say, is being left off of here. I want to make note of that. But look at all the previous years. So during 2009, there were companies giving out their dividends, surely. However, by the way, they reduced them in many cases. This here shows us that there was essentially no buybacks taking place. Everybody's concerned. Everybody's worried. I want to also touch on the fact, look at these first few years, year 2000s, how you can see the amount of buybacks are very low in comparison to what we see today. It's absurd. The amount that we're buying back here in 2018. It's ridiculous as far as I'm concerned. People say it's okay, it's great, of course, because you own FANG stocks and you are reaping the rewards of that. But on the way down, it hurts a lot more, I assure you. And then to show you what has happened with Facebook stock and compare that to Berkshire. So Berkshire, you could say, is sort of spread out in what they own. A lot of different types of stocks, peaked out end of January as all of the other ones did, and has since come down. Facebook stock, on the other hand, also came down here. This started the recovery with the rest of the FANG stocks, and then we had all of those whole privacy issues, the data scandals, all of the turmoil that was experienced, and the stock sold off big time. But don't worry about it because there's a lot of quantitative easing out there. There's a lot of buybacks that are taking place, and it pushed the Facebook stock to new records. That's all you need is trillions of dollars in quantitative easing. You need billions and billions and billions of dollars of stock buybacks and some favorable regulations. You need 0% taxes, and you can have a successful mega corporation as well. That's it. That's the key to success, overnight success. That's all. And I'll end it there. If you found the video informative, please give me a thumbs up. If you hate my face, hate my guts, hate my voice, give me a thumbs down. Last but not least, if you want the financial education that was not taught to you in schools, these two books have it all. You can actually see what's in these books, the diagrams, the charts, and everything. If you go over to Amazon, the link is in the description of this video. Take a look through it for yourself. And if you're more interested in the audiobook version, you can get that at themoneygps.com.